You hear it all the time on the news, right? The Fed is raising interest rates. It sounds so simple. But what if I told you that for decades, even the smartest economists in the world couldn't agree on how to actually measure what the Fed was doing? It's kind of wild. Today, we're going to crack open a landmark 1998 paper by Bernanke and Ilian Mihov that finally brought some real clarity to this huge economic puzzle. Okay, so let's boil it all down to this one simple question. When the Federal Reserve makes a move, what are they doing? Are they hitting the gas to get the economy moving faster, or are they slamming on the brakes to cool things down?
You'd think that would be a pretty easy question to answer. But here is the really surprising part. For decades, top economists were all over the place. And get this, they weren't arguing about the effects of a Fed decision. They were stuck on the most basic question of all. How do we even measure what the Fed just did?
And that confusion, well, it leads us right to the heart of the problem this paper wanted to solve. For years, economists were all playing the same game, but they were using completely different rulebooks. Before this paper came along, you basically had two different camps. First, there was the narrative approach. These guys would literally read the Fed's meeting minutes to try and figure out their intentions. The good part? You're getting the story straight from the source. The bad part? It's totally subjective, and you can't put a hard number on it. Then you had the other camp, the stats people, with their big, complex models. They were objective and data-driven, which is great, but they tended to latch onto a single and often conflicting piece of the puzzle. And this created, well, a total mess. You had some researchers swearing that the federal funds rate, that's the interest rate banks charge each other, was the only thing that mattered. Then others would say, no, you have to look at non-borrowed reserves. That's basically the cash banks have on hand. And you had still others looking at the reserves banks did have to borrow. It was like everyone was staring at a different dial on the dashboard and they were all shouting out different directions. And let me be clear, this wasn't just some academic squabble. This had huge consequences. The economist Martin Eichenbaum said it perfectly back in '92. Your entire conclusion about the economy depended very sensitively on which measure you chose to use. The stakes for getting this right were enormous. So into this complete confusion step Bernanke and Mihov, and their paper offered a key insight that just changed the entire game. They basically said, forget about looking at just one dial, we're going to model the Fed's entire playbook. Here's a great way to think about it. The old way of doing things was like trying to figure out if a driver is being reckless by only looking at their speedometer. The car's going 70 miles per hour. Is that fast? Well, I don't know. Are they on the highway or in a school zone? The number by itself doesn't tell you the whole story. You're missing all the critical context. And that's exactly what Bernanke and Mihov did. Instead of just staring at the speedometer, they decided to pop the hood and build a model of the entire engine to see how it really works. For the Fed, that engine room is the market for bank reserves. Think of it as the hidden plumbing of the financial system. It's where the Fed actually interacts with commercial banks. And by modeling the supply and demand in this market, the whole shebang, they could finally isolate the Fed's intentional actions from all the other random market noise. Their process was simple but so powerful. First, model that reserves market. Second, use the model to cleanly pull out the policy shock, that's a deliberate move by the Fed, from all the routine market chatter. And third, once they had that pure signal, they could work backward and see which of the old indicators was actually the right one for different periods in history. So what happened when they took this new method and applied it to decades of economic data? This is where things get really interesting. The results didn't just settle a debate. In a way, they rewrote economic history. Their model looked at these key chunks of Fed history. Before 1979, things were pretty stable and the Fed focused on the federal funds rate. But then, bam, the Volcker experiment from 1979 to '82, a legendary, chaotic time. And then after 1988, under Alan Greenspan, things seemed to go back to that old focus on the funds rate. And right here, this is the smoking gun. Now, this chart looks a bit technical, but what it's showing is the probability that the Fed was using its normal playbook. As you can see, it's chugging along at 100% until late 1979, when it just falls off a cliff to zero. It stays at zero through the whole Volcker experiment and then bam, jumps right back to 100% in 1982. This isn't a subtle hint. This is the data screaming that the Fed literally ripped up its own rulebook for a few years. So the crucial point is this. The model gave hard statistical proof for something historians had suspected for a long time. The Fed didn't have one consistent strategy. For a brief but incredibly critical period, it just changed the game plan entirely. And this meant that for years,
Economists have been using the wrong tool for the job. The model showed that, yeah, before 79 and after 88, the federal funds rate was a pretty good measure. But during those chaotic Volcker years, the correct thing to look at was non-borrowed reserves. One single measure just didn't work for all time. So, okay, this is a great story of academic detective work, but what does it actually mean for the real world? Why does picking the right measurement even matter? Let's just ask it directly. So what? Why should this debate from the 90s have any relevance to your job, your mortgage, or your savings? This graph is the answer. It might look a little complicated, but the story is simple. The different lines show the estimated impact of a Fed policy change on the economy's output, on GDP. And just look at them. Depending on which of those old, flawed measures you use, the estimated effect is wildly different. In some cases, the impact is more than twice as large. And that right there shows you the real-world stakes. Using the wrong measure isn't just a small statistical error. It's the difference between seeing a Fed action as a gentle nudge to the economy or a powerful shove that could send it into a recession. That's the cost of getting it wrong. This breakthrough also helps solve other economic puzzles. For years, economists were arguing about something called the vanishing liquidity effect. That's the idea that when the Fed pumps more money into the system, interest rates go down. But people were starting to say it didn't work anymore. Well, this paper showed the effect wasn't vanishing at all. It was just an illusion created by researchers who were using the wrong indicator during that post-Volcker period. Ultimately, this paper leaves us with a really profound thought. It gave us the tools to finally get a clear picture of the Fed's past actions. But it also raises a huge question for today. If we can't accurately measure the economic policies of the past, how can we ever hope to confidently navigate the challenges of the future?